Silver has crossed $90 an ounce. A level that just a few years ago sounded impossible has now become reality. But the real question isn't how silver got here. The real question is what happens next. As geopolitical tensions rise around Greenland, markets are reacting fast. Stocks are shaking, gold is surging, and silver, long ignored, long underestimated, has broken out with force. Historically, when silver clears a major psychological level, it doesn't move slowly. It moves violently. With global uncertainty increasing, supply already tight, and investors rushing toward hard assets, analysts are now asking a serious question. Is $90 just the beginning? Could silver be setting up for a move toward $120 in the coming days? To answer that, we need to understand why this breakout matters, and why Greenland may be the spark accelerating a much larger move. The breakout above $90 did not happen in a vacuum. It happened because the conditions beneath the market have been quietly changing for years. Silver is not just another precious metal. It sits at a rare crossroads between money and necessity. Unlike gold, which is primarily held and stored, silver is consumed. Once it is used in electronics, medical equipment, solar panels, and advanced manufacturing, much of it is never recovered. This creates a structural tension in the market, one that most investors only notice when prices begin to surge. For years, global demand for silver has been rising steadily. Electrification, renewable energy, data centers, electric vehicles, all of them require silver. At the same time, mine supply has struggled to keep up. New discoveries are rare, production costs are rising, and most silver is mined as a byproduct of other metals, meaning supply cannot easily increase even when prices rise. By the time silver reached $90, the market was already tight. Inventories were lower than they appeared. Physical availability was thinner than paper markets suggested. The system was balanced, but fragile. Then, geopolitical risk entered the equation. As tensions around Greenland escalated, markets began repricing risk across the board. Investors didn't just worry about tariffs or diplomacy, they worried about trust. Trust between allies, trust in trade routes, trust in the stability of the global order. And when trust weakens, capital moves fast. Gold was the first destination, as it always is. But silver followed with speed, and then with momentum. Once silver cleared key resistance levels, technical traders stepped in, algorithms activated, momentum funds repositioned. What began as a defensive move turned into a breakout. This is where silver behaves differently from most assets. Because the silver market is relatively small, it does not take enormous amounts of capital to move prices dramatically. When buying pressure increases, prices can rise quickly, sometimes violently. And when that movement confirms a breakout, it attracts even more buyers. This feedback loop is what transforms a rally into a surge. At $90, silver crossed more than a price level. It crossed a psychological boundary. It forced investors to reassess assumptions that had gone unchallenged for years. For a long time, silver was treated as secondary, a metal that followed gold, a commodity too volatile to take seriously. But volatility cuts both ways, and when conditions align, silver has a history of outperforming nearly everything else. This is why analysts began revisiting higher price targets almost immediately. Not because $120 was guaranteed, but because it became mathematically conceivable. Historical silver bull markets show a clear pattern. Long periods of consolidation are followed by short, explosive moves. Prices do not climb step by step, they leap. The breakout above $90 fits that pattern, but the question now is not how silver moved so far so fast. The question is whether the forces driving it are temporary or structural. If geopolitical tensions ease quickly, speculative money could exit just as fast as it entered. Silver could retrace sharply. This has happened before. But if uncertainty persists, if trust continues to erode, if supply constraints remain unresolved, if investors continue seeking assets outside the financial system, then the breakout may only be the beginning. In that scenario, $90 is no longer the ceiling. It becomes the floor. And once silver establishes a new floor, the market begins searching for the next level where sellers emerge. For many analysts, that level sits near $120, not because it is inevitable, but because, under current conditions, it is no longer unthinkable. Silver is no longer reacting to a single headline. It is responding to a world that feels increasingly unstable, and markets, when they sense instability, rarely stop at the first warning sign. As silver pushed beyond $90, something subtle but important began to change in market behavior. The conversation shifted from disbelief to positioning. When prices are low, investors debate whether an asset is worth owning. When prices rise sharply, the question becomes far more urgent. How much exposure is enough, and how much is too little? This shift in mindset matters because markets are driven as much by psychology as by fundamentals. Once participants accept that a new price range is possible, resistance weakens. What once looked expensive begins to look early. This is especially true in the silver market. Silver has a long history of sudden repricing. For extended periods, it trades quietly, building pressure beneath the surface. Then, when conditions align, it releases that pressure in short, dramatic bursts. These moves are rarely smooth. They are emotional, volatile, and often faster than anyone expects. The current environment mirrors many of those historical moments. Technically, silver has exited a multi-year consolidation zone. Long-term resistance levels that capped price action for years have been decisively broken. Once this occurs, technical models stop anchoring to the past and begin projecting forward. This is where targets like $120 emerge. They are not predictions in the traditional sense. They are reference points, areas where previous market behavior suggests supply may reappear. Until those areas are tested, momentum often continues. At the same time, tension is building between paper and physical silver markets. The vast majority of silver trading does not involve actual metal changing hands. It exists as contracts, derivatives, and promises settled in cash. Under normal conditions, this system functions smoothly, but during periods of stress, confidence in paper claims can weaken. As prices rise and headlines amplify uncertainty, more investors seek physical silver, bars, coins, allocated storage. This shifts demand away from paper instruments and toward real metal. When physical demand increases, it exposes a critical vulnerability. There is far less silver available for immediate delivery than the market implies. This does not automatically cause a breakdown, but it tightens conditions further. Premiums rise, delivery times extend, and the perception of scarcity grows. Perception alone can move markets. If participants believe supply is constrained, they are more willing to buy aggressively and less willing to sell. This changes market behavior at every level. Add to this the role of leverage. Many traders in silver use leverage to amplify returns. Leverage accelerates gains, but it also accelerates losses. When prices rise rapidly, short positions are forced to cover. This creates additional buying pressure, pushing prices even higher. This dynamic, known as a short squeeze, has historically played a major role in silver's most explosive rallies. The move above $90 likely triggered waves of forced covering, and if prices continue higher, additional pressure points may emerge. This is why silver rarely moves in a straight line. It surges, pauses, and then surges again. Still, risks remain. Silver's volatility is a double-edged sword. A sudden shift in sentiment, a diplomatic breakthrough, a stabilization in markets, a sharp rise in the dollar could trigger a violent correction. This possibility cannot be ignored. But corrections do not invalidate breakouts. In strong bull phases, they often reinforce them by shaking out weak hands and resetting momentum. The deeper question is whether the underlying drivers remain intact. As long as global uncertainty persists, supply remains constrained, and trust in traditional systems remains fragile, silver retains its appeal. In that environment, price targets once considered extreme become reference points rather than fantasies. $120 is not a line drawn at random. It reflects historical volatility, structural scarcity, and the psychology of markets under stress. Silver does not need perfection to reach such levels. It only needs instability and a lack of confidence that the system will quickly return to normal. And right now, normal feels further away than it has in years. As the silver market looks ahead, the most important question is no longer how high prices can go, but what kind of world makes such prices possible. Silver does not rise in isolation. It rises when confidence weakens, in institutions, in currencies, and in the assumptions that once felt unshakable. The move above $90 and the discussion around $120 are reflections of that reality. The Greenland situation is a reminder that geopolitical risk is no longer distant or theoretical. It is active, it is unpredictable, and it has the power to disrupt markets that have grown accustomed to stability. Even if the immediate tensions ease, the message has already been delivered. Strategic competition is intensifying, trade relationships are becoming conditional, and political leverage is increasingly intertwined with economic pressure. Markets adapt quickly to these signals. For silver, this environment creates both opportunity and risk. On one hand, silver benefits from its unique position. It is scarce, tangible, and independent of any single government. It is embedded in the technology shaping the future, yet rooted in a monetary history thousands of years old. On the other hand, silver remains volatile. It reacts sharply to shifts in sentiment. A resolution to geopolitical tensions, a surge in confidence, or a return of speculative appetite for risk assets could trigger rapid pullbacks. This is the paradox of silver. It thrives on uncertainty, but it never moves quietly. If the rally were to stall, it would not mean the story is over. It would mean the market is recalibrating, digesting gains, and reassessing risk. Strong trends often pause before resuming. But if uncertainty deepens, if trust continues to erode and structural pressures remain unresolved, then silver's role in the financial system may continue to expand. In that case, $120 would not represent an endpoint, it would represent a milestone. History shows that during periods of monetary stress, precious metals tend to overshoot expectations. They move not just to fair value, but beyond it, as fear and momentum reinforce each other. Silver's smaller market magnifies this effect. When demand rises, there is little buffer. Prices adjust upward quickly, sometimes violently. This is why silver commands respect during turbulent times. It is not predictable, it is not stable, but it is honest. It reflects scarcity, it reflects demand, and it reflects the collective psychology of a world navigating uncertainty. As investors, analysts, and observers debate whether silver can reach $120, the deeper issue remains unresolved. What happens if instability becomes the norm rather than the exception? If that shift continues, silver's relevance will not fade with a single headline or diplomatic breakthrough. It will persist as a hedge, a resource, and a signal. The Greenland crisis may eventually be remembered as a footnote or as a turning point, not because of what was decided politically, but because of what markets revealed in response. They revealed fragility, they revealed sensitivity to risk, and they revealed how quickly capital moves when confidence cracks. Silver's surge is part of that revelation. Whether prices pause, retreat, or push higher, the breakout above $90 has already changed the conversation. It has reset expectations. It has forced a reassessment of what is possible. And in markets, once something becomes possible, it rarely remains hypothetical for long. Silver is no longer whispering, it is sending a signal. The question now is not whether the market heard it, but how it chooses to respond.